here I'm going to try to briefly explain how to price a bond, and I'm going to be using an example of a bond issue at a discount. And so I would say the very first step you need to do here is take the face amount of those bonds. In this case, I'm just giving it to you as $1 million. The CR, or contract rate, on those bonds is 6%. It will be 12% for the full year, but since these are actually semi-annual interest payments, the semi-annual interest rate would be 6%. So every period, the interest payment every 6 months would be $1 million times 6%, or $60,000. That becomes your cash flow every period, every 6 months, and that becomes your annuity. Now, to price bonds, keep in mind you must present value the interest payments and also the face amount that you return to the investor at the end of the period. Now, I'm going to give you a very simplified version of what's happening when I say that. So I'm going to actually do a timeline, and in terms of the bonds cash flows, what this is saying really is, you have 1, 2, that's 1 year or 2 periods. 3, 4, that's period 4, so second year, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. This bond that I'm just giving to you at this point is a $1 million face bond, 12% annual contract rate, 5 years. So it's 5-year term, 10 periods. So each period, these bonds provide the investor with $60,000 of interest payment. $60,000 here again, and so on. The very same thing, 10 times. The investor also, at the end of the life of the bond, receives the full face amount of those bonds, or $1 million. So imagine you're saying that this investor is getting a total of $60,000 times 10 periods, so $600,000 in cash payments from the interest from the contract. In addition to that, they're getting their money back, at least in terms of the face amount. So this investor is getting back the full $1 million plus the interest. Fine. But in reality, that is not really the present value of those bonds. You need to present value these cash flows to the present. This one over 1 period, this one over 2 periods, this one over 3, and so on. But that's a lot of work. So there's another way to do this in a very short cut kind of way. Then this one also gets, this last cash flow also gets present value using another sort of present value calculation. So here's what you see right there. So the step 2, after you determine what is the cash flow from the interest payments, which is again your annuity, you're going to take that payment, in this case $60,000, apply the present value factor for the annuity of 7.188, and I'll show you later how to get to that. And if you multiply that together, you will see that 60,000 times 7.1888 gives you a total present value of $431,000, or $330,000. So even though the overall cash outflow is $600,000, in reality the present value of that amount would be $431,330. Also, separately, you take the face amount that you return to the investor, or you're going to return to the investor at the end of the use of the life of the bond, 10 periods or 5 years later, and you're going to also multiply that times the present value factor for a single amount. In this case, it will be 0.5327. Again, I'll show you later how to get to that. Multiply that together, that gives you a total present value of $532,726. Together, the $431 from the interest payments, the present value, and the present value of the face together gives you a total present value for those bonds, for those cash flows from that bond of $964,056. Notice that the difference between the face of $1 million, which is, I guess, that amount there, and the amount determined by the present value calculation, that difference becomes a discount. And the difference there becomes what is the additional interest provided to the investor effectively, because they only provide proceeds of cash to the issuer of this much, but they get the full amount at the end. So the difference becomes additional interest revenue to the investor or interest expense to us. With respect to how to get to that present value factors, here's the answer. Now, I didn't give you this before, but there's the market rate is 13%. So it's higher than the contract rate of 12%. Remember that to get to the $60,000 interest payment, we halved that 12% contract rate to 4%. In the same way, the 13% gets halved to 6.5%. That's the rate that we use to get to the present value factor. So that's the reason I'm actually highlighting this column here in this table. So you can go to the 6.5% column and then go down to the number of periods. In this case, as we said before, there are actually 10 periods or 10 interest payments. So with these two columns intersect, that will provide you with the present value factor for that annuity. Now, if you did not have this table, you can always rely on this present value factor formula. It will be 1 over R, or interest rate, minus 1 over R times 1 plus R to the T. In this case, as you can see, the R would be 6.5%, and the T, or periods, would be 10. This table was derived in each case here the very same way. Now, that's the present value of an annuity table. In the same way, to get to the present value of present value of a single amount, you will use a different table. The setup is very similar to the previous one, but it has different numbers, as you can see. Is based on this other formula here, 1 over 1 plus R to the T. Again, R being interest rate and T being number of periods. R in this case will be 6.5% again, and T will be 10 periods. So you go down the 6.5% column, you go to the row 10, and when they intersect, that provides you with that present value factor for that calculation, for the face amount. And again, you can always rely on this instead.